SK Hynix is coming to US markets. And right now, every investor with an AI thesis is scrambling to get a piece of memory storage stocks. But let me stop you right there, because most of you are about to buy the wrong name at the wrong time for the wrong reason. I'm Phoebe, and you're watching TradingKey. Today, I'm going to show you something that Wall Street's top research desks already know, but nobody's saying loudly enough. The hottest stock in AI memory might actually be the worst near-term earnings trade in the group. And the boring name everyone's ignoring, that's where the real money is being printed right now. We're breaking down the entire AI memory supply chain, HBM, DRAM, NAND, SSD. And I'm going to tell you exactly who's eating first, who's eating second, and who's just picking up scraps at the end. SK Hynix, Micron, Samsung, SanDisk. 4 companies. 3 very different ways to win. Let's go. How AI actually uses memory. Stop me if you've heard this before. AI needs more memory, buy everything. That's lazy analysis, and it will cost you real money. The memory stack has distinct layers, each with completely different profit dynamics. If you don't know the difference, you're gambling, not investing. Here's how it actually works. Every AI model does 3 things: reads data, runs computation, stores output. 3 functions, 3 layers, 3 separate investment theses. Think of an AI data center like a factory. The GPU is the engine doing all the heavy computation. Right next to that engine, sitting millimeters away from the chip, is HBM, high bandwidth memory. This is the ultra-fast express lane, stacked vertically and placed physically beside the GPU, so data moves with almost 0 delay. Old memory is like putting the warehouse across town. HBM is like building the warehouse directly above the production line. That's not an optimization. That's a fundamental redesign. The next layer out is server DRAM, the working memory that handles AI inference, agent task management, multi-turn conversations, and what's called KV cache. One GPU server today needs between 200 and 400 gigabytes of DRAM. We went from dozens of gigabytes to hundreds, almost overnight. Then, at the back of the chain, you have enterprise NAND and SSDs, the permanent storage layer where AI keeps vectored databases, model memory, conversation logs, workflow history, everything that doesn't need to sit beside the GPU every second. 3 layers, 3 different profit stories. And mixing them up is exactly how investors buy the right theme at the wrong point in the cycle. Why HBM gets the premium multiple. Hynix controls around 57% of global HBM supply. It's Nvidia's most critical memory partner. The stock ran over 800% in a year. The narrative is clean, the momentum is real, and the margins are actually lagging right now. Yes, you heard that right. Bernstein, arguably the most respected independent semiconductor research house on the street, put out analysis showing HBM's profitability is materially below conventional DRAM. For HBM to match DRAM's profit margins, prices need to rise another 2 to 2.5 times from here. That's not a small gap, that's a chasm. So why is Hynix valued like a monopoly, while companies with structurally better margins trade at a discount? Because Wall Street isn't paying for today's earnings, it's paying for the moat. Here's the key insight. Standard DRAM is a commodity. Any competitor can ramp supply when prices spike and the premium evaporates overnight. Hynix's HBM technology is genuinely hard to replicate. It's hard to qualify, hard to replace, and deeply tied to Nvidia's GPU roadmap. Samsung and Micron have been chasing it for years and still aren't there. The high PE multiple is the market saying, this competitive advantage is durable, and we'll pay up for that now even if the full profits come later. You're not buying earnings. You're buying scarcity. That's the first key insight. SK Hynix is the best pure-play HBM valuation story, but not the cleanest near-term earnings acceleration story. Those are 2 different trades. Now, one more thing on Samsung. 6 months ago, everyone wrote them off on HBM. Now look at the data. Korea's semiconductor exports hit an all-time high in May. HBM packaging exports spiked 79% in a single month. Bernstein says Samsung's HBM4 capacity is scaling steadily from 2026 onward. And here's what makes this trade interesting. The market doesn't need Samsung to become the leader overnight. It only needs Samsung to prove the gap is narrowing. Expectation repair can be extremely powerful, and that's exactly the setup we're looking at. Why DRAM may be the real profit engine. Okay, forget the hype for a second. You want to know where the actual cash is flowing in this cycle? It's not HBM. It's the product everyone stopped talking about, conventional DRAM. Here's the mechanism. Every major memory manufacturer has been ripping wafer capacity away from standard DRAM to produce HBM. That supply destruction is brutal. Meanwhile, AI inference demand is exploding. Agents, multi-step workflows, long context windows, massive KV cache requirements. Supply is cratering. Demand is spiking. You know what happens next. Bernstein's June report spells it out. Conventional DRAM prices are up roughly 4.5 times cumulative, from Q3 2025 to Q2 2026. With another 25% upside remaining before the cycle peaks. Here's the number that should stop you cold. On the same wafer capacity, conventional DRAM generates more than double the revenue of HBM this year and nearly triple the gross profit dollars. Both Micron and Samsung said it directly on their earnings calls. Non-HBM DRAM margins are running higher than HBM margins. Higher, right now, today. This is the critical difference between a valuation story and an earnings revision story. SK Hynix gets the premium multiple because investors believe in HBM scarcity. Micron gets the operating leverage because DRAM pricing flows directly into revenue, gross margin, and free cash flow. For investors, that distinction is everything. Micron's last print was a blowout. Revenue up multiple times year over year. Data center revenue up nearly 7 times. 60% of total revenue now coming from cloud and data centers. Next quarter, guidance came in at $49 to $51 billion, nearly 20% above what analysts expected. Bernstein estimates Micron's overall DRAM gross margin at around 85% in fiscal Q3 2026. That is not a typo. Micron has HBM exposure, but HBM is only roughly 2% of total revenue. The earnings engine is DRAM, and the market still isn't giving it the same premium it gives Hynix. That's the disconnect. That's the trade. Samsung plays this differently, and it's the only name in this group that runs both sides of the book simultaneously. On one side, HBM4 is scaling and the expectation recovery is accelerating. On the other side, Samsung holds the world's largest conventional DRAM production base, so every dollar of DRAM price appreciation hits its income statement hard. Add aggressive buybacks on top, and you have a multi-catalyst setup with significant re-rating potential if execution keeps improving. NAND and SSD, when AI runs out of fast memory. Now we're at the back of the chain, and this is where things get spicy, in both directions. AI agents don't just compute, they generate. Every reasoning chain, every multi-step workflow, every agentic task produces enormous volumes of data that HBM and DRAM simply can't hold. It overflows into enterprise SSDs and NAND flash, vector databases, retrieval indexes, model states, system logs, user context, embeddings, all of it lands in this layer. And as AI scales, that data volume is growing exponentially. Bernstein's data makes this concrete. Across a full AI data center rack, DRAM and NAND price increases together are pushing capital expenditures up by nearly 30% for major cloud providers. DRAM and NAND alone account for 14 percentage points of that cost increase. That's not a rounding error. That's structural pricing power showing up in real CapEx budgets. SanDisk is the purest expression of this trade. No HBM, no DRAM, just NAND and SSD. The stock is up over 700% this year. Western Digital and Seagate have also ripped. Capital that made its money on front-end HBM and DRAM is now rotating toward the storage layer in real time. But I'm going to be straight with you. This is the most dangerous trade in the group. Bernstein rates pure NAND names conservatively, and the reason is straightforward. There's no scarcity moat here. There's no HBM-style qualification barrier protecting margins. Production scales faster, competition is brutal, and when the cycle turns, NAND stocks don't drift lower, they fall off a cliff. This is a high beta, late cycle momentum trade. Treat it exactly like that. Explosive upside when the rotation is hot, but size it like the speculative bet it is. How to classify the 4 stocks. Here's the clean investment framework. Stop treating these as one trade. They're not. SK Hynix is your pure HBM scarcity play. You're buying technical leadership, Nvidia proximity, and a competitive moat that competitors have spent years trying to close. Earnings may lag today's hype, but the PE expansion story isn't over because the strategic position is real. Micron is your near-term earnings quality play. If the question is which name has the clearest path to near-term fundamental upside in this entire sector, Micron is the center of that conversation. DRAM price leverage is going straight to the bottom line right now, and the market hasn't fully closed the valuation gap with Hynix. Samsung is your recovery and diversification play. 2 catalysts, HBM4 execution closing the gap, and DRAM cycle leverage, with a cheaper valuation than both Hynix and Micron. The highest risk-adjusted setup in the group if you believe the memory cycle has legs. SanDisk is your speculative catch-up play. Explosive upside when AI data growth forces the storage layer rotation, no structural protection when the cycle cools. Size it like the high beta bet it is. Don't chase the story, chase the margin. Here's the real alpha from everything we just covered. Most investors are still asking the wrong question. They ask who is closest to Nvidia. That matters, but it is not enough. The better question is, where is the bottleneck? Where is the pricing power? And where is the market still underestimating earnings? HBM drives the narrative. DRAM is driving the near-term profit surprise. NAND and SSDs are the late cycle catch-up. 3 layers, 3 trades, 3 completely different risk profiles. Don't just chase the hottest AI memory headline. Follow the profit pool. Because in every semiconductor cycle, the best trade is never just the company with the best story. It's the company where supply, demand, pricing, and expectations all move in the same direction at the same time. So here's what I want from you. Drop your conviction pick in the comments right now. HBM, DRAM, or SSDs, which part of the AI memory chain do you think has the best setup from here, and which stock are you most bullish on heading into the second half of the year? Let's debate it below. Subscribe to TradingKey for more breakdowns like this. I'm Phoebe. See you next time.